the higher the gross margin you have, the more money you have to invest in marketing or anything else along those lines.
So Cyrus is going to talk about budgeting, and we're going to talk about what a budget is, why the pest control businesses need a budget, who should be involved in the budgeting, and what does the process look like. So I guess the first thing that we'll talk about when you budget, probably the easiest thing to do is to take your profit and loss in QuickBooks by month, print it or produce it, push it out to Excel, and then erase all the numbers. So you've got all of the accounts and then all of the months, and now you're going to do your budget, okay? And the first thing you're going to start off with is your revenue budget. And so, Cy, how do you recommend that we do a revenue budget?
Yeah, so typically when you want to start doing a budget, right, we're going to start with 3 items that we're taking a look at. We're looking at your recurring services, your recurring revenue, your renewals for that particular year, and then your one-times, right? So what's important about doing this is recurring and your renewals establish a bench line of where you're going to be for next year, right? We got to take into account attrition a little bit, but the other piece of the puzzle is the one-times, right? So we're going to have to resell all the new sales to reach that one-time goal, and then on top of that, we're going to have to grow to wherever we're going to look to be, right? So attrition is another one that I mentioned before. It's really important to take a look at. So best-in-class companies, Dan, and correct me if I'm wrong, but typically what we see is between 12 and 18% attrition every year, right? So we're going to have to build that into what we're looking at of total top-line revenue based on those renewals and recurring.
So what's really interesting about what he said is, I want to grow 10%. If I'm best-in-class company, I really have to grow 22 or 28, right? So I have to replace what I lose, and then I have to increase by 10%. Now, if most of my revenue was one time, then I have to replace all that one time again. So that's the power of recurring service. The other thing is we're talking about how to win in the game of business. And so let's define winning in the game of business. So in case you've been under a rock, you know that the M&A frenzy in this industry is alive and well. And the valuations are high. And why are the valuations high? Because the smart money has recognized that recurring revenue is extremely powerful, okay? Profitable recurring revenue. So when you're doing your budget, you want to make sure that you break it into revenue and into recurring and one-times. And so what are some of the reports that you would pull from, say, PestPack and Suite?
Yeah, so in PestPack,
or Field Routes.
Yeah, PestPack, a good one to start with would be the business valuation report. It's going to pretty much establish your bench line for next year. Field Routes, the reports that we'd use would be like a billing by service type. Take a look at the different divisions and the services that you're offering that way.
Yeah, so just to kind of make it real clear, what you've got is you've got a pie and you've got 3 slices. One of the slices is the service setups or the route work. The other slice is the renewals, and the final slice is the one-times. That's the what you've got to sell in order to make it all up, okay? And so that's the wild card. The interesting thing about doing your budgeting this way, year 1, when we do these, we're maybe 5-6% off, but year 2 and beyond, we're within 2 to 3 points. And that's the beauty of recurring revenue, right? That's the beauty of the information that you can get from PestPack and or Field Routes, right? So the revenue box, you're going to break it into commercial, residential, maybe if you have lawn care, something like that. You're going to, within that, it's going to be recurring and non-recurring. You always want to know your percentage of recurring versus non-recurring. That's how you know you're winning in the game of business, because the higher the recurring and profitably, the more that you're going to value the business.
Yeah.
So under the revenue, there's cost of goods sold or direct costs.
Yep, yeah, absolutely. So yeah, cost of goods sold, Dan mentioned it a little bit here. So remember, the one thing to note for these is that they're essentially your direct costs, or they're going to be variable, right? So they're going to fluctuate with how much production and revenue that you're doing for that particular year. So what's going to fall in those buckets, right? We're going to have the technician labor. So you're paying your techs to go out there, bonuses, commissions, payroll taxes, maybe you offer health benefits, right? That's all going to fall in there. We're going to have the actual material expense, so the chemicals that you're using to service the customer. Your auto, right? So your insurance for your auto, your fuel expense, maintenance, whatever it may be for that, and then any other direct cost, right? So this is another topic that is pretty interesting in the industry, but its other direct costs would be workers' compensation, general liability, uniform expense, things like that. You might ask the question, why do we include those in there, right? So workers' comp and general liability, they're pretty much all based off gross receipts or the type of revenue that you're doing. So that's why we include that cost in with the gross margin, the cost of goods sold.
So that's an interesting one, right? So there's theoretical accounting arguments that you could say, well, your workers' comp or your general liability should be below the line, but I argue that it should be above the line. The only reason I mention it is our chart of accounts that we use is above the line, and I believe that Rollins and Renick, the same thing, right? And the reason that that's important is because if I ask you what your gross margin is, and you're including it above the line, and I ask you what yours is, and you're not including it, you could have different answers with the same information. But the reason that I use our chart of accounts, it's something that we've developed over the 20 years, but it's also, if you were to look at the internal Rollins, Renick, P&Ls, our chart of accounts lines up with that. And it's basically this whole revenue, cost of goods sold, gross margin. So talk about the gross margin. Why is that important?
Definitely one of the most single important metrics to take a look at in this industry. Reason being, right, so typically in this industry, we're seeing a 50 to 55% gross margin.
Using our chart of accounts?
Yep, using the standard chart of accounts that we've built out. Could be higher, could be lower, depending on where you're at, what type of services you're doing, maybe what your pricing is. But the reason why it's so important is, so let's take an example. If we have $100 of billing and we're running a 50% gross margin, now we've got $50 to now cover everything else, right? The sales and marketing, the general and admin, different wages, CSRs, things like that, right? So now if we do $200 worth of service and we're running 50%, now we have 100, right? So you can see kind of how it spirals down and really builds up. So the higher the gross margin you have, the more money you have to invest in marketing or anything else along those lines.
So to add to that, if you have a 50% gross margin, and let's say it costs $100,000 a month to run your office, including marketing and whatnot, that means your break-even point is $200,000, right? 50% goes to produce the service, and 50% goes to pay off all of that office with those fixed costs, right? And what's really powerful about the pest control model is that on $200,001, you make 50 cents, right? So every dollar after that, you're making 50 cents. So one of the interesting things is we'll take a new client, and they'll be making a reasonable profit, and then we'll implement this chart of accounts, and then they'll go out and sell, control their fixed costs, and double their revenue over a couple of years, but their profit doesn't double. It goes up exponentially because every dollar they make over break even, they're making 50 cents or better. I will tell you that door-to-door companies, their gross margins are much higher. Anybody know why? No? Route density. Right, that's exactly right. Okay. So that's kind of interesting. Let's talk about the next area on the P&L that we budget for, and that's sales and marketing.
Yeah, definitely. So they're broken up into two different segments, right? So Dan mentioned sales and then marketing. So what is the difference between the two? Marketing is essentially everything that you're paying to bring that lead in, right? So local service, Google Local, pay-per-click, any other digital marketing company that you're using. The sales portion is everything that you spend to now close that lead, right? So it's really important to see. So when we're putting together this budget and we're looking at revenue, right, we have to anticipate how many leads that we're going to need to kind of hit our goal, right? We have to take a look into our closing percentages. So when you're looking at all of that, right, we can come up with an idea of how many leads that we potentially would need to hit our sales goal, and then formulate that in with the cost per lead and kind of see how everything comes together.
The interesting part of that is usually you say, well, your labor needs to be 22.5%, and maybe your rent needs to be 2%. If you look at a mature pest control company, the marketing cost is usually around 7 or 8%, but it doesn't have to be, right? Because it's how much do you want to grow, how much are you willing to pay for a lead or a closed sale, and how much does that cost? And that could be a huge piece of your P&L. So if I said 7%, let's say we're selling quarterly service and it's $500 a year for annualized revenue. Let's say that I say that marketing is 7%. That means that it cost me $35 a sale. Who in here would take if I gave you a closed sale for $35, how many would you take?
All of them.
Okay?
Yeah.
However, how does it get to be that 7%? The reason that it gets to be that 7% is because there's a whole bunch of work in your book of business that's more than a year old that doesn't have marketing and sales costs associated with it. And so anybody who was in my talk yesterday, the average age of a customer or in your company, what that does is that will actually bring your marketing costs down, right? Because if I've got 4 years worth of customers that have non-marketing, that's pretty good. But what if I had 8 years or 10 years? Okay, so that when we normalize the marketing cost in a mature company, it turns out that it's 7% or 7 or 8%. Okay, there is one other thing that I wanted to mention is Cyrus mentioned the difference between sales and marketing, and the reason that I suggest that you break up the two is because you could have a marketing problem, meaning that you can't get enough leads or you have to pay up for the leads, but your sales department's closing them at 90%. That's not a sales problem. That's a marketing problem. Or maybe I'm delivering a whole ton of leads, right? And my sales department can't close them. That's a sales problem. So that's why we like to break up the two costs and look at it that way.
Yep.
So let's talk. G&A is just,
It's going to be your general and admin expenses, right? So what's going to fall in those buckets are going to be your CSR wages. Maybe you're the owner of the company, so we like to break out the corporate wages because it's a calculation that we like to use take home to owner as well. Other things that are going to fall in there are going to be your office rent, maybe some computer software expenses like field routes, Pest, Roll Desk, or whatever you're using on that end. Credit card fees and other items like that. But what's important when we're looking at that is that G&A is going to be typically fixed, right? There's going to be certain revenue benchmarks that we're probably going to hit, and then we're going to need to hire another CSR, or we're going to have a new office location and things along those lines. But going back to the break-even point, right? It's going to stay very similar as an overall percentage, and it's just going to help you guys out from a profitability standpoint as you move forward.
And if you start to really move that G&A expense up, that messes with your break-even formula, and so it's not as powerful. Okay. So how easy is it? So basically what we said is you've got revenue minus direct cost equals gross margin minus sales, marketing, and G&A, and that's how you do your budget. How easy is it to enter it into QuickBooks?
Yeah, so at PCO, typically what we're doing is we're building it out on an Excel spreadsheet like Dan mentioned. There's two different ways that we can do it. We can manually enter it in, or we can import it in on that way. But one thing that's important to note when you're building this budget is make sure that your line items are similar, if not exactly like your chart of accounts in QuickBooks or whatever other software that you're using, so that way everything is aligned, and that way when you do input it into that software, it makes sense when you're looking at your budget to actuals. One other thing I wanted to add too on it was a budget is typically static, right? So we don't want to change it too much from month to month. If a drastic event or something, maybe you lose a large customer or something like that, we do want to change it. But the reason why we want to keep it what we assigned it in the beginning of the year or whenever you've made it is because if there is a problem, maybe you're not hitting your sales goal or you're not hitting your revenue, or maybe direct labor is off, we can actually dive into that issue because we're comparing budget to actuals, right? So just something to note that we don't want to always be changing it.
In other words, don't be changing your budget to match your P&L, so at the end of the year.
Everything looks good. Yeah. So.
Any questions on budgeting? Okay. Yes, Gary.
Dan, rolling budget versus annual?
So rolling budget versus annual, QuickBooks doesn't handle it.
Yeah.
so we don't do it, but it's kind of interesting, right? So you can do a month to month and trailing 12 and work that way, but QuickBooks actually makes you put it in for the year. It defines the year. So you can do a rolling budget, but you're going to probably use Excel to do it. Or one of the things that it's kind of interesting. So we work with small companies and large companies and whatnot. A lot of large companies say, yeah, QuickBooks can't, we've outgrown QuickBooks. This is a limitation on QuickBooks. That said, We worked with a company that was over $100 million with, I think, 27 branches, and each one of them were in QuickBooks. The reason that QuickBooks works with such a big company is because we're not in a complicated business, right? If we were in a distribution business with thousands of SKUs and we were assembling things from inventory and whatnot, QuickBooks is a bad solution, right? But we don't have complicated inventories. We don't have any of that. So QuickBooks is a good solution, and it's very cost effective. You could go to an enterprise level software and do rolling budgets and do dynamic budgets. Is it worth it? And is it worth it to learn?